Introducing Kibo, a DeFi options market that's better, fairer, and safer for investors and traders. Our goal is to create the best, most accessible, most secure, and most decentralized exchange for option trading. So what makes Kibo such an exciting and innovative approach to options trading? First, a little background. You likely know that options are a kind of derivative, a contract between a buyer and seller based on the value of something. In the world of crypto, options allow traders to bet on the future price of a crypto asset while limiting their risk in case they bet wrong. One simple example would be paying a fee to buy an asset in the future if the asset reaches a certain price, the strike price. If the asset price reaches or passes the strike price, terrific! The gamble paid off and the trader profits. But if the strike price isn't reached by the maturity date or the value of the asset dips, the option is worthless. Bought and sold with skill, options can be exceptionally lucrative and are thus one of the most traded derivatives in TradFi. That's traditional finance. So it's not surprising that their use in the crypto space is expected to grow rapidly in the coming years. But while crypto options aren't new, the existing platforms for buying and selling are less than ideal. Most options trading is conducted on centralized platforms like Deribit or Bybit, and that centralization comes with problems. Counterparty risk, meaning that the person you're dealing with doesn't fulfill their end of the deal. Bankruptcy risk, if the platform goes bust while you still hold options. Regulatory issues, because the platforms aren't fully accountable. And a lack of flexibility in terms of how you invest. Unfortunately, most non-centralized or DeFi platforms are also problematic. Some of them aren't even exchanges at all. They're options vaults, like Ribbon or ThetaNuts. Actual on-chain option exchanges like Hedgic or Open suffer from multiple flaws. They often lack liquidity, the pricing models are often wrong, and they make things risky for liquidity providers. Kibo does away with all of these problems and delivers a transparent, flexible, and secure way to buy and sell crypto options. Let's see how it works in practice, shall we? Alice is an options trader who wants to get into the crypto space, but she doesn't know about Kibo yet. Alice wants to buy an option that matures in 3 months, but on the first platform she visits, she can't find any. Unlike Kibo, the only platform to trade long-term options, this exchange is only offering 1 to 2 week maturity option. Alice is disappointed, but she's eager to get started, so she buys a 2-week option. A few days later, her option is in the money. It's reached its strike price, and she decides to sell. But she can't! The platform has run out of liquidity, so sales are currently blocked. Alice is stuck with her option until it reaches maturity at 2 weeks, and the price could drop by then. Not great. But Alice doesn't give up. She hopes she'll have better luck with another platform, and this time she decides to try selling options. Unfortunately, another roadblock. Most platforms don't allow traders to sell options. Alice really wants to make some plays, but she's feeling pretty frustrated. She finally finds an exchange to work with and is about to sell an option when her friend Bob asks if she's tried Kibo. Alice decides to sell options on both exchanges, posting 1 Bitcoin of collateral on each. On the other exchange, her 1 Bitcoins of collateral earns her about $250, which is okay, but on Kibo, her 1 Bitcoin of collateral earns her $1,000. How? Bob explains that on other platforms, options are 100% collateralized, but on Kibo, Alice just needs to post the initial margin. So instead of using 1 Bitcoin to sell a single option and earn $250, Alice can use 1 Bitcoin to sell 4 options and earn $1,000. Bob then explains that Kibo can do this because of the way the platform is designed. For example, if there's a significant price change in the underlying asset, Kibo asks traders to provide additional collateral. If traders can't provide that collateral, their position is liquidated using Kibo's on-chain auction mechanism. Bob says that Kibo also uses auto-balancing to keep its market much more liquid than other platforms, which means Alice will never be stuck with an option she can't resell. Kibo's unique auto-rebalancing function works like this. When Alice sells an option on Kibo and Bob buys the same option, Kibo doesn't need to post any liquidity. The transactions balance each other. And if Alice sells only one option but Bob buys two, Kibo needs to post only 1 unit of collateral. Better still, this even works with different options. If Alice sells an option of strike $1,500, that is to say the target price of the option is $1,500, and Bob buys an option of strike $2,000, Kibo doesn't need to post any collateral. And when Alice sells an option strike $2,000 and Bob buys one strike of $1,500, Kibo needs to post only $500, much less than would be required on an exchange without auto-balancing. Other platforms can only post as much collateral as their liquidity providers can offer. Kibo's auto-balancing means that when the number of options bought and sold is similar, the liquidity is virtually unlimited. Kibo's architecture includes another pillar that helps maximize the available liquidity by eliminating fragmentation. Imagine a platform with 2 pools that liquidity providers can fund, Ethereum and Bitcoin. On most platforms, these pools are separate. If traders want to trade ETH options, but the market's liquidity providers have only filled the BTC pool, traders can't trade and liquidity providers don't earn money. Everyone loses. Other layers of fragmentation can stop the free flow of liquidity. Different types of options, put and call, different strike prices, different maturity dates. Kibo breaks down these barriers and offers a trading environment with zero fragmentation. Liquidity can be allocated wherever it's needed. Kibo's pricing model also offers several advantages. Whereas other platforms set prices for derivatives using off-chain data or an oracle, Kibo's option pricing is determined entirely by market forces. In other words, traders buying and selling. It isn't dependent on a centralized exchange. This allows Kibo more flexibility on options to trade, with more maturities and more strike prices. It also means Kibo is the only platform to trade options on crypto assets such as Uni, Link, or Doge. After 6 months of trading crypto options, Alice, who's loving the freedom and security Kibo offers, has noticed something odd. She tells Bob that $1,000 of liquidity she invested to one platform has become just $500, but that the entire $1,000 she provided on Kibo is still there, plus the revenue generated by fees. Bob reminds her that the current value of an option is governed by many factors, including several kinds of risk calculations, including delta risk, which measures the impact of a change in the price of an underlying asset, and the vega risk, which measures how volatile those price changes are. He also tells her that on all options, AMM, whether they know it or not, liquidity providers like her are providing the collateral for options sold to traders. When, for example, the implied volatility of an option changes in a particular direction, people like her are covering the difference. And that problem is amplified when an oracle is calculating the implied volatility. Instead, Kibo adjusts its pricing to hedge the liquidity against this risk. It makes sense that option prices will change as the price of the underlying asset changes. So of course, when liquidity providers underwrite the buying or selling of options on an exchange, they carry the risk. And those risks can be enormous, even infinite. Rather than leaving things to chance, Kibo automatically hedges the market risk with offsetting instruments that protects liquidity in the event of major moves up or down in the value of underlying assets. In addition to being the most advanced trading platform for crypto options, Kibo aims to extend its utility and benefits by integrating with other protocols. That's why we decided to build UniHedge on top of Kibo for liquidity providers on the decentralized exchange Uniswap. Providing liquidity on Uniswap is very risky. Liquidity providers face the famous phenomenon of impermanent loss, which can be costly for LPs. It is possible to hedge impermanent loss yourself if you have the sophisticated skills required. You can also hire a company like Orbit to provide permanent loss protection, but these centralized services are only available to professional market makers or exchanges. UniHedge allows all liquidity providers to completely hedge their impermanent loss, giving them the freedom to provide liquidity on Uniswap with peace of mind. In addition, it's decentralized, and the cost of hedging is in line with our centralized competitors. Options are Kibo's core business, but the platform targets the exotic derivative market as a whole. In fact, Kibo is the first protocol to offer on-chain credit default swaps, or CDSs, for crypto platforms. This powerful facility has two main use cases. The first is insurance. Suppose Alice deposits assets on a popular centralized exchange to earn interest. But if that exchange fails, she stands to lose her entire investment. Buying a CDS protects her. And the second is speculation. Unlike traditional insurance, a CDS can be used to buy protection even if you don't own assets on a particular exchange. If Bob thinks an exchange might default, he can buy a CDS and earn money if the platform falls into bankruptcy. Kibo offers an unprecedented array of possibilities for investors interested in exploring the world of derivatives. As you've seen, Kibo's DeFi derivatives market offers greater earnings potential, optimum flexibility, and robust protection of your investments, leading the way as the appetite for crypto options prepares for rapid growth.